Hi, everyone. Welcome to today's webinar, Taxes in the Age of COVID. I am so glad you are here with us. And if you're listening later, I am very glad you are listening later. Era, I'm going to kick it over to you to share some words of welcome if you'd like.
Sure. Welcome, everyone. I'm super excited to be able to present this information to working artists who are trying to navigate finances in the times of a pandemic, because there is a lot of information, ever-changing information, as we were just kind of talking about before we officially started. It's a lot to take in. So I'm glad to provide this resource so that you can be more confident in preparing your taxes and other financial things coming out of this pandemic, and hopefully have some confidence around that. I do, of course, want to thank the organization that made today's webinar, plus the additional two that we have coming up later on possible, and that is Neighbor Up, or Neighborhood Connections. They are funding this through one of their COVID rapid response grants, and I just want to especially thank them for realizing that artists have kind of some particular struggles during this pandemic, and that helping them navigate the financial changes is really going to have an impact on the community and on the individuals that are benefiting from this. So thank you, Neighbor Up. And Elaine, you're going to talk about the additional 2 sessions at the end of this session, or do you want me to talk a little bit about that? You got it? Okay.
I'm going to talk about them. Yeah.
Well, then I think that's all that I have to say. I guess I should say I'm with Tailspinner Children's Theater Company. I forgot that part. And so we're happy to be presenting these, and a special thanks to Luis Gomez, who works with Cuyahoga Arts and Culture, but kind of is involved in this project as a private citizen and advocate for the arts himself. So I think that's it. To you I go, Elaine.
Thank you, Era. I appreciate it so much. Huge thanks to everyone who came together to make this possible. Era and Luis for sure, and then also all of the organizations that are providing support, because it is absolutely crucial and it does take a village. As Era mentioned, my name is Elaine. I use she, her pronouns, and I am based in Dublin, Ohio, which is just a smidge north of Columbus on Kashkashkia and Hopewell Indigenous and cultural lands. If you are listening instead of watching, I'll share a visual description of myself. I am a 40-year-old white female with wavy blondish brownish hair that is much longer than it was at this time last year, and I am wearing red glasses and a gray jacket today. I am also the luckiest CPA money person ever, because I have the great privilege of working with creative individuals all over the country to help individual creatives and organizations with the business and financial side of their creativity. I work with visual artists, performing artists, and literary artists, and it is such a privilege to be able to be doing this work. I wanted to share a few ground rules. In this space, we want to make sure that everyone feels empowered to both take space and make space for others. I have the chat window open, so if you have questions you'd like me to make sure to address that are not included, by all means, please put them in the chat and I will address them. It's also important to note that we're all equal parts teachers and learners. So you get to take this information and decide how you make it work in your own creative practice. And of course, we want to make sure that stories do stay within this space in case any are shared, but by all means, take the lessons from those stories and carry them with you. This is being recorded, and as of today, all of the information I'm going to share is current. Today is March 18th, 2021. And we know that tax laws are changing and evolving in real time this year. So if you are listening to it later, keep in mind that it is very possible that some things will have been updated, which is a great adventure we all get to have this year. So what are we doing? Clearly, we are talking about taxes, but more specifically, I wanted to take some time to review the federal tax landscape as it is right now. And then we'll definitely spend some time talking about common deductions that creative individuals often claim when they file the business tax return, Schedule C for most individuals. And then we'll call out and highlight some specific COVID-related 2020 changes. These will be relevant as you're preparing your current year tax return. And going forward, there are a few things that will stick around for at least another year or so. So we'll make sure to highlight those as well. As Era mentioned, this is part of a 3-webinar series. Today, we're talking about taxes. We thought this would be timely in that tax day is generally April 15th, but as of yesterday, the IRS extended the tax filing deadline to May 15th of this year. Of course, that falls on a Saturday, so technically it's extended until May 17th, but you have an extra month or so to think about taxes and to navigate some of these real-time changes. It is expected that most states will also follow suit on extending their deadlines, but definitely pay attention to what's going on in your own state. A couple weeks from now, we will follow up this tax conversation with a conversation around record keeping. So we know we need to keep records for tax purposes, and we learned they became very important in applying for unemployment and PPP loans last year and all sorts of other good stuff like that. But there's also sort of an intentionality that can be associated with keeping records. So we'll talk about some systems and habits that might work for you on April 8th. And then our third conversation is where we transition out of nitty-gritty taxes and record keeping and look a little bit more broadly at the funding landscape and some opportunities for creative individuals to redefine their value and respond to the world that will be evolving as we all emerge from this pandemic moment in time. So that's scheduled for May 6th. And I very much hope you will be able to join us for all of these conversations. I should say as well that even though I am a CPA, everything we're talking about today is educational in nature and is not intended to be used as tax, legal, or accounting advice. But having said that, let's talk about how federal income taxes work. This is my visual representation of Form 1040. If you've spent a lot of time with the tax forms, you know that there's a lot of text there, they're pretty dense, and sometimes they are hard to navigate. So I've tried to call out kind of the key things in this visual representation, and then we'll dive into each of them in a little bit more detail. If you are a permanent resident of the United States or a dual citizen or a US citizen, you get to file a tax return in the United States, and you're probably filing Form 1040. Our non-residents file Form 1040-NR, and there's a link here if you have dual citizenship or other international tax concerns. There are some great resources from the IRS that you can dig into in a bit more detail. One of the questions that came in from a participant in advance of this webinar was about different tax filing options that might exist. So I wanted to call your attention to a couple of different resources. First is the Volunteer Income Tax Assistance Program. This is a group of volunteers authorized by the IRS to assist individuals with filing their tax returns, as long as those individuals have income whose income less than $57,000 or so. There's a link there if you want to find some of these amazing humans nearby where you are. But I will say, if you have a tax situation that involves a business you are running, say as a creative individual, or some other complications, the volunteers may not be able to assist you. The IRS also has a free file program if your adjusted gross income is below $72,000. You can link to the IRS website to have more information about that. And while you're on the IRS website, if you'd like to investigate any of the authorized e-filers that the IRS work with, you can enter your zip code and gather some of that information. Whether you are filing on your own using paper or using a software platform like TurboTax or TaxAct or Free Tax USA, all of which I have individuals I work with that use and like for different reasons, or if you're using a human to help you prepare your taxes, definitely make sure you're finding a system that works for you. So at the top of the Form 1040, we have all the human information the IRS needs. They get your name, address, your filing status, and then any dependents that are listed on your tax form as well. And then we get into the numbers. The first thing you'll enter is any income you had from a W-2 job. This is a job where you were treated as an employee of an employer. And as an employee, the employer was withholding taxes and matching those Social Security and Medicare withholdings as well. And in the arts, it becomes really important to figure out how you get paid. And it seems like it should be an easy question, but it is not always all that straightforward. In general, we see that creative individuals often have W-2 income. So if you are working as an employee for someone else, you will have W-2 income. And you might also receive some 1099s. This would be contract work you might be doing, freelance work, any sort of other work outside of a W-2 job that you might be doing. And the reason we care about this is because the geography of where this gets reported on your tax return matters, right? And it's different based on how you are paid. If you are a W-2 employee, that goes right on the front of your Form 1040 as salaries and wages. And the big thing to remember here is that you have no deductions associated with your W-2 job, right? So even if you have out-of-pocket expenses that your employer does not reimburse you for, those are not deductible to you. So many of you may have found yourselves working from home over the past year or so for your employer. If you purchased new lighting or extra cables for your computer or a microphone or anything else to make your working from home setup more comfortable, and your employer did not reimburse you for those, you cannot deduct those expenses because they're associated with your W-2 job, right? So if you have a W-2 job, no expenses associated with that job are deductible. But if you think about the exact same situation where you don't have a W-2 job or you have a separate business for yourself, and to continue running that business last year, you bought cables for your computer and a light and a microphone, those are all deductible business expenses if you are running your own business. So this is why the geography of how you are paid starts to really matter from a tax perspective. Running your own business gets reported on Schedule C generally if you are a sole proprietor or if you are the only owner of a limited liability company. If you have a limited liability company with multiple owners, or you have a partnership or an S corporation, all of that gets reported on a separate tax return, and then the income flows through on Schedule E. All of the same things are deductible, but again, the geography of where these numbers go matters a little bit. Also, if you sell any work directly to the public, you wouldn't necessarily get a 1099 for that, but you would still have income from that, and that income would also be reported on your Schedule C. So let's talk a little bit more about some of these other income items. We know W-2 job, no deductions, goes on the 1040. That's pretty easy. But other income on Schedule 1 starts to get a little bit more complicated. I'll draw your attention to line 7 on Schedule 1. This is where you would report unemployment compensation. So if you collected unemployment during 2020, and this is true if it was regular old unemployment or if it was the Pandemic Unemployment Assistance Program that expanded eligibility to freelancers and creative individuals, no matter how you got that unemployment, if you received unemployment, that is taxable income to you. And that gets reported on line 7 of Schedule 1. Now, not too long ago, Congress passed and President Biden signed into law a third round of stimulus and some additional benefits. And one of the provisions of that legislation was that the first $10,200 of unemployment compensation someone received in 2020 was not subject to federal tax. So this legislation was signed into law on March 11th, which created a little bit of chaos because all of the tax forms had already been printed and many had already been collected. And now we need to make an adjustment to what people are reporting for unemployment compensation. So the IRS has issued guidance that basically says they're going to add line 8 here. And instead of it saying other income, this is where they're going to show an adjustment that basically excludes $10,200 of unemployment compensation. So the guidance has come out from the IRS. Many of our friends that work for tax preparation software companies have not yet incorporated that guidance into their software platforms because it's really complicated. The latest I heard was that many of them were hoping to get to it by tonight, the evening of March 18th. But what I would say is that if you have not filed yet and you collected unemployment in 2020, give them a week or so. Now that we have that extended tax deadline of May 15th, right, you have a little bit more breathing room. So give them a week to update the software and kind of sort through the kinks. Also, pay attention to what your state is doing, because this legislation exempted that first $10,200 from federal income tax, and states get to decide if they are going to also exempt that first $10,200 from state income tax or not. Remember, our federal legislation cannot set state laws, so those decisions are still to come. So just watch it, and if you have not already filed your tax return and this applies to you, give it a week or so just to kind of let the dust settle and see what's going on. If you have already filed your tax return, you may need to file an amended tax return that then basically kind of adjusts for this, which is annoying and frustrating, but it probably will end up being better for you since you're able to exclude some of that taxable income. The other thing that comes up on Schedule 1 is line 3, and this says business income or loss, attach Schedule C. And so if you are a creative individual that's running your own business, you are going to be reporting income and expenses from that business on Schedule C. And then all of that data flows through right here to Schedule 1, and then ultimately it ends up on the front of your 1040. This is kind of what that looks like, and this is one of those domino frustrations sometimes of tax world, where you start in one form and then you're sent to another and then to another to get to greater and greater levels of detail. This is what the top of your Schedule C looks like. The form is called Profit or Loss from Business, and it gathers some general information, the name of the business, the address, and then also a special standard industry classification code. This goes in box B, and the instructions here say enter code from instructions. So if you can get your hands on the Schedule C instructions, it's a PDF file available on the IRS website. If you flip to the last 2 pages, you will see a long list of 6-digit codes, and each one is associated with a different industry. So you know your business best. It's your job to identify which industry you operate in. Code 711510 is the code for independent artists, writers, and performers. So for many of the people I work with, that's the code they use. But there are also different codes for specialized design services and some other creative disciplines. So find the code that makes sense for you and make sure it goes at the top of your Schedule C. I mentioned the name of the form was Profit or Loss from Business, which sort of begs the question, are you running a business? And for many individuals, this is one of the bigger questions to have to answer as you're thinking about preparing your tax return. To answer this question, we look at a couple different things, and these are creative things to kind of think through and analyze. These are not necessarily bright line tests that you have to follow. But first, we look at, do you approach what you are doing professionally? And specifically, do you keep books and records? Are you tracking your income and your expenses and your clients or collectors? Are you gathering data? Are you paying attention to grants you're applying for or shows you are submitting to? All of those types of organizational things and books and records suggest that you are, in fact, running a business. It also helps if you have a business plan, if you are kind of thinking through strategically what this will look like, and of course, if you approach it in a professional manner. We also look at if you spend enough time on it to make it profitable. If you occasionally make a painting once a year, that doesn't really feel like you're running a business. But if you are regularly making work, regularly showing work, regularly attempting to sell work, that starts to indicate that you are spending enough time on it to make it profitable. We also look to see if you have the knowledge needed to make it successful. Is this something you just woke up and decided you wanted to start doing today? Or have you built up expertise in this over time? Obviously, the latter suggests that you are running a business as opposed to being a hobbyist or doing something just for fun. And of course, it helps if you make money from it. If you are generating positive taxable income, and especially if it's your primary source of income, that helps indicate that you are in fact running a business instead of doing something as a hobby. And I've used that word twice now, the word hobby. And that comes up for a lot of individuals because you may have heard that the IRS has a rule that if you engage in an activity for profit, that means you are running a business if you make money in 3 out of 5 years. And that is true. That is the rebuttable presumption of the IRS. But it is a rebuttable presumption. Obviously, I want you to make money from your creative business. I want you to have positive taxable income in all of the years that you operate because that's good for you. But there are years when you may have a loss. And if you have a loss, that is okay, as long as you are still actively engaged in running the business with the intention of making a profit. And if you look into some of the tax court cases where taxpayers and the IRS have essentially had conversations around if something is a business or if it's a hobby, right? We see that one of the overwhelming determining factors is if you intend to make money from it. So how do you intend to make money from your art? Well, you apply for things, you show your work, you adjust things that are not necessarily working for you, you increase your professionalism and the books and the records that you are keeping. All of those things help support the fact that you are in fact running a business, even if it does occasionally have a loss. So let's pretend you are running a business. If you are, then you are able to deduct ordinary and necessary business expenses. But what does that mean? An expense is deductible, or it's a deduction or a write-off, depending on what terminology you're most familiar with, if it reduces your taxable income. So a deduction basically makes your total income from your business go down. You report what you earn minus all of those deductions or deductible expenses or write-offs, and that gets to your taxable income number. And that's the amount that you effectively pay tax on. So how do we know if something is deductible? In general, although there are always exceptions and special rules, but in general, an expense is deductible to you if it is ordinary and necessary and effectively connected to your trade or business. So the IRS defines ordinary as common and accepted in your industry. Remember that industry classification code on Schedule C? Yeah, that matters, right? Because we want to make sure the expenses you're incurring are common and accepted in your industry. IRS defines necessary as helpful and appropriate for your trade or business. So as you are going through the analysis of all of the expenses that you have had connected to your business, all of a sudden the question becomes, is this ordinary? Is this necessary? And is it connected to my business? And if so, it's probably deductible unless there's one of those special rules. This is the part of Schedule C where you report those expenses. And you'll see there are some lines that come up for individuals pretty regularly. Advertising is a good one. Supplies is a good one. Travel, for sure, in the arts, especially during normal times, right? But you'll also see way down here on line 27A, there's a line for other expenses. And this is where if you have something that doesn't fit in another good category, you can report it in this section called other expenses, and you can define the category that makes sense for your business. I would just say, make sure it doesn't fit into one of these existing categories, and then be consistent in what you're calling the categories year after year. To dive into a few specific examples, I wanted to pull some of what I hear that regularly comes up for creative individuals. And one of the most common things individuals spend money on in the arts is professional support. If you are hiring an accountant or an attorney to review a contract here or there, or maybe a web designer, or if you are hiring people as independent contractors to provide support for your business. Maybe you hire someone to be a fabricator on a particular project, or maybe you hire someone to run PR for an event you're having, right? Those are all types of professional support that you might have for your business. And as long as you document the business purpose, that is probably deductible. It probably ends up on either the contract labor line if you are hiring someone as a contractor, or on the line for legal and professional fees if you are engaging an attorney or an accountant or something like that. And if you are hiring people as contractors, make sure you're clear on the relationship with them. And if you have a 1099 filing obligation, make sure you are adhering to that. So you are collecting a W-9 from those individuals, and then at the end of the year, you are sending 1099s to them if you need to. That's another example of those books and records that you would be keeping to demonstrate that you are engaging in this activity professionally, as opposed to kind of casually or just for fun. Another category that gets a lot of use in the arts are deductions for hardware or equipment. So any sort of hardware or equipment you might buy for your business. If you're an illustrator, you might have a Cintiq that you use. If you are a musician, you might have an instrument. If you are a potter, you might have a kiln. If you are a DJ, you might have a special dedicated performance computer that you use that you don't use for anything else to keep it from getting cluttered, right? All of those things are examples of different equipment that would be ordinary and necessary and effectively connected to your trade or business, depending on what you're doing. So what do? We make sure we're documenting the business purpose of the equipment. And for things that might be a little bit personal and a little bit business related, we make sure we're clear on bifurcating or splitting the use of that asset between business and personal use. In my example of the DJ, that person was using the computer entirely for their performance work. There was no personal use. But maybe in your creative discipline, you have a computer and it's used mostly for business, but also for personal purposes as well. What you would want to do is track the usage and make sure you're bifurcating or dividing the usage between business usage, which is probably deductible, and personal usage, which is not deductible. And for things like computers or cell phones, the IRS calls those listed assets. So you want to make sure you're using it at least 50% for your business purpose. And then if so, you can multiply the business use percentage times the cost of the thing, and then claim that as an ordinary and necessary business expense, because it is. I'll also note that if you are purchasing additional insurance for any of these business assets or equipment, that insurance is probably deductible as well. So let's say you're a photographer and your studio is in your home and you have a really nice camera. You have like a $4,000 camera and you use it 100% in your business. In addition to deducting the cost of the camera in the year you purchase it, you might also purchase additional insurance on that camera. Maybe you say, my studio is in my home, so my renter's insurance or my homeowner's insurance will probably cover it, but let me check. And maybe you dig into your policy and you realize that your homeowner's insurance policy or your renter's insurance has a $1,000 per item limit. That means if you have a $4,000 camera that gets damaged, the insurance policy will only cover $1,000 of a replacement cost. So that's not good for your business. So you might purchase an additional insurance rider for that specific piece of equipment. And in that case, that would be a deductible business expense. Software and subscriptions are also generally deductible. Again, we want to make sure we're documenting the business purpose of the software or the subscriptions we're using, and make sure, of course, it is ordinary and necessary to your business. And then also keep in mind that we use a lot of things when it comes to software and subscriptions. So take a moment to just take your own inventory. Do you pay for additional Google Drive storage or an external hard drive that you need to have access to back up client images of your work or something like that? Do you pay for Dropbox storage or any of those other kind of things would be ordinary and necessary deductions for your creative business. Creative supplies come up all the time for my visual artist friends. So if you use supplies in the creation of the thing you sell, those supplies are probably deductible. but you can deduct them in two different ways depending on what type of work you create. So let's say you create very, very large pieces and it's pretty easy to track the supplies that you're using to create each piece. In that regard, you would probably deduct the cost of each piece when you sell the piece, and we would deduct it as a cost of sales, because before that, the piece is part of your inventory. It is still an asset to you. But what if you also make prints of what you're creating, right? So maybe you make a large work and then you take a photograph of it and create prints of the work. It's much harder to track the cost of each print, and it's probably a couple of pennies. So in that case, it might not be feasible for you to track the cost of the sale of each print. You might end up just deducting those types of creative supplies on the line for materials and supplies. So it comes down to essentially how easy is it for you to track, right? And are the supplies like small and de minimis, or are they pretty substantial? So your creative supplies are deductible, and they are deductible as cost of sales on Schedule C. And there's a great formula there to help you kind of walk through that calculation. It's on the back of Schedule C, right at the top of the second page. Or if your supplies are what we would call de minimis or of minimal value in the production of the work, you can probably deduct them on the materials and supplies line. Professional attire comes up a lot. So let's pretend you are invited to give an artist talk, and to give that talk, you purchase a new garment, and it fills you with confidence and your talk goes really, really well. If that is a garment you could wear somewhere else, even if you wouldn't, it's probably not deductible to you. Because the rule on professional attire is that if you could wear it somewhere else, it is not deductible. But when it comes to safety equipment or special performance shoes for any of my performing arts friends, you wouldn't certainly wear shoes that you would wear on Marley outside. It would damage them, right? So that wouldn't be appropriate for any other use. Those would be deductible. Or if you're thinking about possibly renting a garment and then returning it, that rental expense could probably be deductible because you wouldn't have the asset to continue wearing. Also, smocks, steel-toed boots if you work with heavy equipment in your studio, goggles, gloves, any of that kind of safety equipment would probably be deductible. This is an area that sometimes trips people up. So remember, the general rule is if you can wear it somewhere else, it is not deductible. Research is another area that comes up for a lot of creative individuals. And this is an area that you really could abuse. And I would suggest you do not abuse this. So be honest with yourself about the research that is actually connected to your body of work. And again, is it ordinary? Is it necessary? And is it effectively connected to your trade or business? And those are the hurdles to clear if you are deducting research. So let's pretend you are creating a body of work and you need to purchase some books for reference. That feels like it is pretty legitimately research. Or maybe you are writing a play about a historical figure and you purchase reference material about that person, and you travel to visit a library where information about that person is housed. That feels like research to me. But if one day you dream about writing a play about a sports team that you love, and you start going to that team's games, that doesn't really feel like research to me. That feels like something you just enjoy doing. So be honest with yourself and remember, ordinary, necessary, effectively connected with your trade or business is what we're going for here. Office supplies are generally deductible and they are not particularly controversial. I would say though, if you are purchasing office supplies from somewhere that doesn't feel like an office supply store, make sure you're documenting and saving the receipt to show what it is that you purchased. Sort of a related example that just came up, someone works in theater and was purchasing some supplies for a film set. And the supplies were candles, and they purchased them from like a TJ Maxx or a Marshalls or something like that, right? because that feels like it's not totally clear what they were buying and why, that would be an example where you would want to definitely document the business purpose and make it clear that it was something related to an ordinary and necessary business expense, as opposed to a garment you were purchasing from this store or something like that. Marketing materials are also generally deductible, and they're not super controversial. So if you were paying to promote posts on social media, or doing some sponsored posts, or if you print up show cards for an event you're having, all of those things would generally be deductible. Home office or home studio space is another good one. And this is one of those deductions where you want to make sure you are really following the letter of the law. And I will direct you to publication 583 from the IRS. The whole publication is great. It's called Starting a Business and Keeping Records. And there's a really, really wonderful discussion on business use of your home there with some really good examples. So that's a good resource if you want to dig into this in more detail. But in general, the space in your home that you are using for your business must be used exclusively and regularly for that business purpose. It needs to be your principal place of business, and you can't have any other place where you conduct administrative tasks related to your business. So if this applies to you, my suggestion would be get a copy of your floor plan and document the space within your home that is used exclusively and regularly for your business. Maybe it's a separate room, maybe it is a portion of a room, maybe it is a garage or a space that's a separate unit in the back of your property. Whatever it is, document that space and then measure it and figure out what percentage it is of your overall home space. And then that percentage is what we would multiply by your mortgage or your rent payment and your utilities to calculate the deduction for business use of your home. Definitely save that copy of the floor plan where you're noting the space, because that's an important part of your tax records. And I would also suggest taking some images of the space, especially if you might move in the next 7 or so years while your statute of limitations is open, because that's going to be a good way to document the space in case anyone ever has any questions about the business use of your home. I will also say the space has to be used exclusively and regularly for your business purpose. And some of our home office spaces were thrown in a bit of turmoil last year. So I will remind you that any deductions associated with your W-2 job are not deductions to you, right? So if you had any expenses associated with your W-2 job, that is not deductible. So there is no home office deduction just because you were working from home last year, right? But if there is legitimate business use of your home for your own business, then this is a deduction you might be eligible to claim. Creative individuals also travel a lot, as we know. So expenses for travel, meals while you're traveling, and lodging are also generally deductible. But this is another one where there are some special rules. The primary purpose of the trip has to be business related. And this is one of those things where you want to save all of your receipts for the trip, right? Because that helps establish that the trip happened and you actually did go to this place, whether it is a hotel receipt, Airbnb, confirmation email, meal receipts, any of those things confirm that you were in fact traveling to that place. As I mentioned, the primary purpose has to be business related. And in general, meals that you consume while you're traveling are deductible, but they are subject to a 50% limitation, meaning you can only deduct half of the cost of the meal. That is a special rule that is changing during 2021 and 2022, though, so I'll come back to that in a second. I also want to call out, if you have a W-2 job, it is possible that you may have some unreimbursed employee expenses here. And remember, those are not deductible. So let's pretend, in addition to running your own creative practice, you have a teaching position and you are a W-2 employee of the educational institution. And they give you a $1,500 grant to travel to a conference where you are doing a reading of your work or presenting some of your academic work or something like that. But let's say your expenses for the trip actually ended up being $1,800 instead of $1,500. Well, you've spent $300 extra that were not reimbursed by your institution. And if that trip was associated with your W-2 job, that extra $300 is not deductible to you. So you could ask if there's additional grant money. There may or may not be, but keep in mind that, again, we have to keep W-2 job and expenses separate from things related to our creative practice. And if you are teaching about the thing that is your practice, this can get really blurry. And it's your job to keep them separate and to document that separation clearly. Business meals in general are deductible. So that means if Era and Luisa and I have lunch to talk about this webinar series and I purchase lunch for all three of us, I could deduct the cost of that meal as a business expense, as long as it is ordinary and necessary, and as long as we discuss something business related. So feedback on the webinar series, for example, would be a great example of that. Now, even though that's a deductible, ordinary, and necessary business expense, my deduction is limited to 50% of the cost. So if our meal for all three of us comes to $100, I can only deduct $50, 50% of the cost, except in the year 2021 and 2022. As part of the legislation that passed in December, so not the most recent stimulus legislation, but the round that passed in December, there was a provision in there acknowledging that our hospitality industry has been hit very hard and that it would be helpful if businesses were possibly incentivized to have business meetings at restaurants or purchase meals from restaurants in conjunction with a business purpose. So Congress is allowing 100% of business meals that are ordinary and necessary, right? Same rules still apply, but 100% of them can be deducted in 2021 and 2022. This does not affect your 2020 tax return that you are filing now. 50% limitation still applies. But going forward, know that any meals you have while you're traveling or associated with your business will be 100% deductible for the next 2 years. Here's a quick summary of some different business meals category. If you have a table at a festival and you have donuts that you offer for free to anyone who's passing by, I probably wouldn't do that in a pandemic, but under normal times, if that's kind of the setup of your table at a festival, that would be an example of a business meal that would be 100% deductible because it's food offered for free to the public. Again, normally business travel meals, meals at conferences, and meals you might have with clients or consultants or other business associates are normally 50% deductible, except for the next 2 years. You may also find yourself using your personal vehicle for business purposes. Perhaps you are driving to that festival and bringing your work and the donuts to set up your table. Or perhaps you are driving to a meeting with a gallerist or a meeting with a producer or something like that. You may deduct costs associated with the business use of your car. And the way we do that is we generally track the miles driven for your business purpose, and we multiply those total miles by the standard IRS rate. For 2020, it was 57.5 cents per business mile driven. For 2021, it's 56 cents per business mile driven. Generally, these rates are adjusted about once a year or so, and they are meant to capture gas costs of your car, but also maintenance of your car and insurance and other things related to your vehicle. So keep in mind that tracking those business miles will generate a deductible business expense for you, especially if you drive around for work or to, travel to see different things associated with your creative business. You do have to keep a written log of the business miles driven. There is an app called Mile IQ that people really love. That's a great way to document your business miles driven. If you are using a system like QuickBooks or something like that, they also have app add-ins that you can use. Or you can keep a little notebook in your car or a log of your trips in Excel or Google Sheets or any other platform, just to document the business miles driven and how you're calculating that deduction. You may participate in certain professional membership organizations. If so, your dues to those organizations are generally deductible. There's a small chance a portion of your dues will be used for lobbying purposes. If that's the case, the organization will tell you. So when they send you an email or a receipt that says, thank you so much for your dues contribution of $150, please note $25 of your dues are used for lobbying purposes. So you would just carve that out from the deduction because lobbying expenses are not deductible. And those tend to be the major categories that come up for most creative individuals I work with. So we have any income reported associated with your business on Schedule C, minus all those ordinary and necessary business deductions, gives you the profit or loss or the net taxable income from your business that then flows through to Schedule 1 and then back to the front of your Form 1040. And then we get to keep adjusting your taxable income. So we've got our W-2 stuff, we've got our net business income, we've got any other income that we needed to report on Schedule 1. And now we start taking some more adjustments. These adjustments to income also come up on Schedule 1, but it's the lower half of the form. The ones I want to draw your attention to are, again, the ones that typically come up for creative individuals. If you have student loans and you are paying interest on those student loans, that is deductible to you. As your income goes up, that deduction starts to get smaller and smaller. It phases out, but it still exists for you until it phases out completely. Or if you are a student, which means you're probably not running a business, you are a student, you may be able to deduct tuition and fees. Again, there are different limitations to this, but know that it exists. And I've referenced a couple of IRS guidance here if you want to dig more deeply into that. If you are self-employed and you purchase health insurance, and if you have no other access to health insurance, so you are not eligible through a W-2 job you may have, you are not eligible through your spouse or partner's employer, right? If you have no other access to health insurance and you're self-employed, you can take a deduction for your health insurance expense. There's also an opportunity to contribute to a health savings account if you have a high deductible insurance plan. And for some individuals, that's a great way to further reduce their taxable income. And of course, you can save for retirement. I would be remiss as a financial planner not to tell you about that. You can certainly make a contribution to an individual retirement account. You can make up to a $6,000 per year contribution to that right now, $7,000 if you're 50 or older. And if you are self-employed and you have positive net income on your Schedule C, you can contribute a portion of that to your self-employed retirement plan. The most common one tends to be a SEP IRA, although a simple plan or a solo 401k plan are viable options as well. And there are different limits for what you can contribute. In general, it's 20 to 25% of the net income from self-employment. So if you are looking to further reduce your taxable income by saving for retirement, this could be an option for you. I also want to draw your attention to a special adjustment that was introduced in 2020. In general, if you make contributions to charitable organizations, those contributions are deductible to you if you itemize your deduction. In 2020, Congress passed a special provision that said, even if you take the standard deduction as a taxpayer, you can deduct up to $300 of a qualified charitable contribution without itemizing your deductions. Again, this was meant to support someone's altruistic motive to make a contribution to charity during a really tough year. So for 2020, that limit was $300. In 2021, that has been extended, which is good news for our friends in the nonprofit sector. And the other change for 2021 is that the $300 limit is not per return, but it could be doubled if the filing status is married filing jointly. So if there are two people associated with the tax return, then the contribution could be doubled to $600. I mentioned standard versus itemized deductions. The standard deduction amounts for 2020 are here. So we have all of our income from W-2, from our jobs, from unemployment, from our businesses. We've adjusted that downward with retirement contributions or anything else we might have. And now we further reduce that amount by the standard deduction amount, which is tied to our filing status. Or we may choose to itemize our deductions if the things that we have spent during the year that are on this list and the rest of Schedule A, this is only a partial list, if those total more than the standard deduction amount, then we would choose to itemize our deduction. So we would reduce our taxable income by whatever is larger. It's important to point out, though, the standard deduction or itemizing your deduction is an either or choice. You choose whichever one is bigger for you. This is totally different from the deductions you claim that are ordinary and necessary and effectively connected to your trade or business, right? So even if you do not itemize your deductions, you still may have business expenses that you are deducting on Schedule C. We then get to a taxable income number, and I'll say, generally speaking, this is the starting point for your state or city tax return. Generally, they look to the federal taxable income number and then adjust from there. And of course, it is your responsibility to investigate the states and cities you might need to pay taxes in, especially if you spent time in multiple places last year because of the pandemic. And then once we know your taxable income for federal tax purposes, then we calculate the tax. We have a progressive income tax system in this country. So the rate gets bigger and bigger as the taxable income goes up. And if you are self-employed, you have the privilege of paying self-employment tax in addition to federal income tax. And this is essentially the Social Security and Medicare contribution that you are making as someone who is self-employed. We look at your Schedule C line 31 number. This is your net income from your business as the starting point for this calculation. We reduce it by a smidge and then we multiply it by 15.3%. That is the self-employment tax rate. If you have a W-2 job, you split this with your employer. So you pay half and they pay half. If you are self-employed, you get to pay the entire amount. And then there is one more chance to further reduce the tax you owe, and this is through credits. Credits allow you to reduce the tax you owe, not your taxable income, but the actual tax itself, which is pretty great. Some of them can reduce the tax all the way to zero. Some of them are what we call refundable credits, meaning they reduce your tax to zero. And then if you still have more credits, the IRS will write you a check for that excess refundable amount. And this is how those stimulus payments were structured last year. This is showing up as a refundable credit on your tax return. It's this recovery rebate credit. Now you don't get it again if you've already gotten it, but this is where it is reported on your tax return. So now we know what your tax is minus any credits, and we compare that tax number to what you paid in during the year, either through withholdings from a W-2 job you may have had, or through estimated tax payments you may have made. And keep in mind, if you have a W-2 job, you can ask them to withhold a little bit extra so that you do not have to worry about estimated tax payments. That's another great reason for keeping one of those W-2 jobs that has that payroll infrastructure. But we add up all of your tax payments during the year, and that's how we figure out if you owe more money, if you have tax due, or if you get a refund. So if your total tax ends up being more than what you paid during the year, guess what? You owe some money. If it's less, then you get a refund. And that is essentially how federal tax system in the United States works for creative individuals. We've got all the human information here on Form 1040. We've got Schedule 1 to capture some additional income and also receive information about our business. And then on Schedule C, you have the income from your business minus any of those ordinary and necessary deductions that help you recapture or calculate your overall taxable income. Then, of course, we adjust for any of those adjustments, like interest on student loans or contributions to retirement or self-employed health insurance if you didn't have access to other health insurance. And then we take the standard deduction, calculate the tax, make it go down more for credits if you're eligible for any, and then compare to what you paid during the year. And then we do the same thing for your state and the same thing for your city if you have city tax obligations as well. I know that was a lot of information. We reviewed the federal tax landscape through the lens of Form 1040. We called out some common deductions for creative entrepreneurs that often get reported on Schedule C. And then we called out some specific COVID-related 2020 changes, including the recent change to unemployment, where the first $10,200 of unemployment is not subject to federal income tax. Also, that additional $300 charitable contribution, and some of the changes going forward to the deduction of business meals. I will pause here to see if there are any other questions. I have not seen any more come through the chat, but if you have additional questions, I am happy to entertain them now.
Elaine, can you remind me where is royalties? Because I feel like that's something that comes up pretty often for artists, and I can't remember off the top of my head if that's something you have to do through a Schedule C or if that can just go directly on the 1040.
Either way is fine. If it kind of depends on whether these are royalties from like a one-time thing that you're not really doing anymore, or if you are actively engaged in the business of writing and collecting royalties, they'd probably live on Schedule C. If it's a more older thing, it probably lives on that other income line of Schedule 1. So that's where I think it's line 8 right now, but it might get punted to line 9 with the addition of the unemployment adjustment. But that is the catch-all for any extra money you get that's not really associated with a business you are running. So let's pretend you are a writer, but you do a little illustration and submit to a contest in the newspaper. If you win a $300 prize, that's going to show up on that other income line. And if you are no longer in the business of being a writer or an actor, depending on what your royalties or your residuals are coming from, then it would go in other income. Great question. We have another question in the chat talking about dues. And the question is, are equity dues deductible if you only have W-2 work? No, they are not. And this was a really big deal change at the end of 2017. That's when the Tax Cuts and Jobs Act passed. And once upon a time, if you had W-2 work, any unreimbursed expenses associated with that W-2 work, so equity dues, the 10% to your manager or agent, right? And possibly out-of-pocket travel expenses associated with W-2 acting, performance, producing work, right? Those all used to be deductible on Schedule A. That's where you itemize your deductions, and there was a line that said miscellaneous, and that's where you would put all of those unreimbursed employee expenses. The Tax Cuts and Jobs Act did away with that. So since that line no longer exists, there's not a place for any of that. Now, depending on how your dues are structured, and also depending on how your manager or agent fee is structured, it is possible that some of them are associated with 1099 work you might do. So you might be able to bifurcate and deduct some on Schedule C. And there were some potentially creative solutions around creative individuals forming S corporations that could receive W-2 payments from different productions, and then S corporations can deduct those expenses. And then here's the other thing, S corporations can pay a salary to the owners. So there was some creative strategizing happening, especially for performers that had most of their income from W-2 work, right? In that case, sometimes S corporations were providing a workaround. An LLC wouldn't give you that same workaround because LLCs cannot pay salaries to their owners, right? So that was sort of the hang up. Is it a salary or not? So definitely kind of a not so great consequence of the Tax Cuts and Jobs Act. But I would say bifurcate if you can, deduct on Schedule C anything that's not associated with W-2 work. Great question.
Elena, I have a question.
Yes, please.
So we were lucky enough that our county received CARES fundings that then was funneled to individual artists through Arts Cleveland. And so if artists receive that, where would that be documented in their tax return?
So first question is, did Arts Cleveland 1099 the artists who received those grants?
I don't know.
Well, here's why I'm asking. This is another one of those strange, dicey situations, right? Because there is a provision of the tax code. It's called Section 139. And it says if you receive emergency relief, that is not taxable income. And so typically we think of like FEMA payments, right? If you live somewhere and your home has been destroyed by a hurricane and FEMA comes and gives you, money for shelter and food and all of those things, that is not taxable income to you. That is emergency relief. And it's not taxable income under Section 139. Now, we know former President Trump declared a national state of emergency. And so some of the emergency relief grants were treated as emergency relief and excluded from income under Section 139. So a lot of individuals who got those emergency grants were not getting 1099s, and they were saying, why not? And then the funders were saying, oh, it was emergency relief. It's not taxable income to you. And everybody was excited. However, that was not sort of blanketly adopted by everyone, right?
Yeah.
So if it came through the city, my gut is it might have been excluded from income, but if you received a 1099, that's pretty clear that it was not. And so if it was emergency relief, like used on groceries, I would probably put it on that other income line. If it was emergency relief for your business, I would probably put it on your Schedule C. Does that help?
Yeah.
Yeah. This was one of those sort of strange situations. And honestly, I have heard different things. I know of at least one funder who was sending out 1099s because their accountant and attorney concluded that they were not comfortable saying it was not taxable income. But I know of other, especially governmental entities, that were very comfortable saying, nope, it's excluded. So, worst case scenario, if you're confused, ask the funder.
Thank you.
Of course. Great question. Other questions?
I have a non-arts related question, so I don't want to take up other. My daughter happened to ask me this last night. She and her husband filed online, and they got a flag at the end that said their Social Security payments didn't line up. And they wondered if they had to find an accountant to deal with that, or
that's a good question.
You've ever encountered?
So it could be a couple of different things. Best case scenario, they did a typo when they were entering the information that was withheld, right? So the first thing I would do is just go back and check the information they entered to make sure it was all entered accurately and it matches what was on the W-2s that they received. That would be the first thing I would check. The second thing could be a reporting error. It is possible that, dollars were withheld and maybe not the right amount was submitted. So that could be what's causing the flag. So talking to the employer to see if, maybe there was an error there could be a good next step. If you can't find any errors after you've done that, there is a chance that there is some sort of identity theft going on. I know that's terrifying to say, but we know sometimes Social Security numbers are compromised, and then someone may have filed their tax return in their name already to try to get a refund. I hope that's not the case, but that would probably, if you can't find another error, that would probably be something to investigate. And if all of those things sort of don't seem to solve the problem, I would say the error message, if it was coming up through tax preparation software, I'd reach out to the software company to help them sort of talk your daughter and her partner through it. if it was coming through directly through the IRS, I would probably reach out to the IRS to see if you could get more information. But they're really backlogged right now. So I think the short answer is no, you don't have to get an accountant. But if you really can't figure out where the error is coming from, then you probably need to go to either the tax prep software or the accountant. And my hope is they typoed the number and it is the easiest fix imaginable.
I think they checked that, but it can't hurt to check again. But yeah, I will pass that along to them. Thank you.
Yeah, sure. Good luck. Any other questions? This has been such a pleasure spending some time with you this afternoon. Huge thank you to Era and Luis and the whole team that came together to fund this program and support it. You will be receiving a copy of this recording, so stay tuned for that. And I hope we will see you in a couple of weeks for part 2, and then a few weeks after that for part 3 of this series. Enjoy the rest of the afternoon, everyone. Thank you again so much, and we will see you again soon.
Thank you.
You bet. Bye.